this one, you're going to get this bearish looking price rejection on your chart. Does it make sense? Okay, let's look at some real examples. So if you look at this chart, right, this is the chart of the 1 hour time frame. Okay, just pay attention. I want you to pay attention to these two areas, right? These two candles, this one, and this one, this one. Briefly visualize in your head, right, that, hey, let's say I'm going to move to a 2 hour time frame right now. How will these patterns change? So let me give you 5 seconds to kind of, work on your visualization. 1, 2, 3, 4, 5. All right, so let's have a look. So if you saw those two patterns earlier, it pretty much is reflected like this on the 2 hour time frame. Can you see what happened? The two 1 hour candles are simply combined to form the pattern that you're seeing right now. Okay, let me just go back a little bit so you can see, right? This one over here, this one plus this one, and this one plus this one. So what happens is you get this candlestick pattern over here and this candlestick pattern over here. All right, so let's just to walk you through why is this green color, because the second candle did close higher above the first. So if you look at it, this second candle over here, it did close higher above this one over here. So that's why you got a bullish close. Okay, and similar for this, right? This candle, it closed, right, but it didn't exceed the open of this candle, so that's why it's still red on the 2 hour time frame, as you can see over here and over here. Okay, so by now I hope you kind of understand how candlestick patterns can be combined. So this is very useful, right, when you're looking at a price chart, let's say the 1 hour time frame, and you can't make sense out of it, right? So if you want to see clearly, what you can do is go on to a 2 hour time frame, and things might be different, right? You might get a clearer view of what's happening. Similarly, if you're on a 4 hour time frame, you can't make sense out of it. Go up to the 8 hour time frame, and things might be clearer for you. Okay, so this is the so-called usefulness, right, of combining candlestick patterns and kind of, just understanding what's going on the big picture. So now, how not to trade candlestick patterns, right? So now you know how to read candlestick patterns, you even know how to combine them. How do you not trade candlestick patterns? Because this is a mistake, right, that I see many new traders make. Because, as I've said, right, earlier, you recall that I say, if the candle is green, it means bullish. If the candle is red, it means bearish, right? The price is closed lower. So what traders will do is that they will look at the chart and they find a series of green candles and they go long. For example, they see over here, wow, man, the candle is green over here, bullish. Let me buy, right? It's so bullish. They go long and bam, market reverse. Similarly, right, they look at the chart. Oh, it's so bearish, right? Red candle. Rainer says, selling, sellers are in control. I should go long. Bam, market reverse, right? Or if they look at, this green candle. Oh, rejection of lower prices. This candle, right? Let me go long. Bam, market reverse. What's going on, right? Why is that so? So I'll explain why shortly. But first, right, the message I'm trying to bring over here is that you don't want to trade candlestick patterns in isolation. What is isolation? It means, right, you don't want to trade candlestick patterns by in itself. Just because the candlestick is green, it doesn't mean you go long. Just because it's red doesn't mean you go short. That's what I mean by isolation. So don't trade candlestick patterns in this manner. Okay, so just a quick recap, right? Candlestick charts, it can be combined, right, as I've shared with you earlier. And also, you don't want to trade candlestick patterns in isolation. So now you might be wondering, okay, Rainer, so how should I trade candlestick patterns, right? So let's talk about that. So how should you trade candlestick patterns? I would like to introduce to you something what I call the TE framework, the TE framework, all right? So what is TE? TE stands for trend, right? A is area of value, and E stands for entry trigger. Okay, so when you want to trade candlestick patterns, right, remember these three things: the trend, the area of value, and the entry trigger. So now, before I can dive into this framework and this methodology, right, I need to explain to you what is entry trigger. Okay, so to do so, right, I would say, so the engulfing pattern, right, this is the so-called the theory behind it, right? So you can see that this green candle over here is what we call the bullish engulfing pattern. Why is that? Because if you look at it, right, the body of the green candle, which is the from here, the open and the close, it has engulfed the body of the previous candle. So this is the previous candle, let's call it number 1, and this number 2, right? You can see that the engulfing candle, bullish engulfing candle, has actually covered the entire body of the first candle. So this is why we call it the bullish engulfing pattern, because the meaning behind it is that if you look at the charts, right? First candle, sellers are in control. They open over here and it closed near the lows. On the second candle, the buyers are somehow on steroids, like bum, right? They're on steroids, right? They open near the lows and they finally push price up all the way up near the highs over here. They are freaking on steroids, right? This is the open and this is the close. So this is a sign of strength, right? As it shows you that the buyers have reversed all the selling pressure and more. So this is why it's called a bullish engulfing pattern, right? Firstly, it engulfed the body of the previous candle, and it's a sign of strength as the buyers have pushed price higher and even closing above the highs of the previous candle. The other pattern is what we call the bearish engulfing pattern. It's just the opposite, right? You can see that the first candle over here is bullish. Buyers are in control, open here, and closing near the highs. But the next candle, sellers took charge and smashed the price lower, right? They opened near the highs as well, but they took charge and finally pushed price lower and closing near the lows over here. So this is a bearish engulfing pattern telling you that, sellers are in control. Okay, so this is the first pattern that I want to share with you, the engulfing pattern. And it's very useful to identify, market reversals. The next one, hammer and shooting star. Ding! All right, so let's have a look at the hammer. So the hammer is something that you might be familiar with because you saw earlier, right, the earlier examples. So the hammer is a bullish reversal because it's actually showing you price rejection in the market. In fact, it's rejection of lower prices. If you look at this, right, the price opened here. And at one point in time, right, the sellers were actually in control, pushing price lower near the lows of this session. And then the buyers came in, took charge. Hey, this is enough, man. I'm coming in, right? They pushed price all the way up higher and finally closing near the highs. Right? So this is a sign of strength, right? Rejection of lower prices. So this is what a hammer means. On the other hand, right, the shooting star is just the opposite, right? It's showing you rejection of higher prices. If you look at this, right, the price opened here. Buyers took charge, pushed the price up higher. But then, hey, sellers suddenly came in and pushed the price down. Maybe, they think that the price is too high. It can't go any higher. They sell, they short the market, and the market collapsed lower, finally closing near the lows. So this is a rejection of higher prices, right? These two patterns, again, are used, right, to help you identify market reversals. Dragonfly and the Gravestone Doji, right? It sounds a handful, but really the pattern is very similar to the hammer and shooting star. The only difference, right, is that now this doji simply means, right, indecision in the markets, but for Dragonfly and Gravestone Doji, it's a sign of price rejection, because if you look at it, right, it's actually very similar to the hammer and shooting star that you've seen earlier. Right, let me just go back a little bit. Hammer, shooting star. Dragonfly Doji, Gravestone Doji. So now let me ask you, what is the difference between the hammer and shooting star and the Dragonfly and Gravestone Doji? If you think about this, right, the only difference is the doji doesn't have a body. There is no body, right? What it just shows you is just the price rejection. So this component over here is the rejection of lower prices. This component over here is the rejection of higher prices. So if you think about this, right, even though the price has opened and closed at the same level, it doesn't mean that the market is undecided, because the market has actually tilted its hand, right? Because at one point, the sellers were in control, pushing price down lower. And then the buyers came in, right, and took charge and finally pushed up all the way up higher and closing near where it opened, exact level. So this is a sign of strength, rejection of lower prices. And this one is just the opposite, right? Price opened at this level, buyers took charge, pushed the price up higher, and then sellers smashed the price down lower, closing at the same level. Okay, so this is a rejection of lower prices, rejection of higher prices. Moving on, right? Morning and evening star. Ding, 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 right? Star. Let's look at the star. So this is a morning star. So you can see that this is somewhat similar to the engulfing pattern, but with a slight variation to it. First candle, sellers are in control. Open over here and closing near the lows. Second candle, which is this doji looking candle, is indecision, right? Because the market opened and closed at the same level.